Welcome, welcome, welcome. This is another production of Biddles Investment Group where we want you to think big, dream big. We've got the light bulb here. What I want to do today is I want to dive into some market crashes. Hey, I don't want to scare you now, but I want to dive into historical market events and I want to compare that with where we are today. And so I'm going to go ahead and start the presentation and don't be fearful. All is okay in comparison to history. So let me share my screen. All right. So hopefully you can see my screen. This is Market Crashes Explained. I'm going to go to 1987 to 2025. We're going to dig into definitions, drivers, and visuals. And so let's go ahead. This is Biddles Investment Group. We have won the National Financial Educators Award. We've been featured on local Fox News and Yahoo Life. Just to give a plug of the professionalism and the information that you are receiving. Our agenda today, we're going to learn about some quick definitions of what a market correction is, a bear market, what a recession is, what a depression is, and this term that keeps coming up called stagflation. We're going to dig into some resources and we're going to check out where we are now. We're going to do some market crash detail from 1987 to 2025. And so we're going to compare those. When you see those comparisons, you might feel a little bit of more relief as far as what's happening in the market today. So I do want to let you all know that you can go grab some indicators. These are indicators of sentiment, not necessarily in corrections, but just uh, fear and greed sentiment. So there's a CNN fear and greed index. It moves towards fear, but rarely hits extreme fear unless it deepens. There's an AAII sentiment survey, gives bullish readings, decline, bearish, or neutral outlooks rise. And there's a put call ratio and the VIX, which you might have been hearing a lot about lately, which is called the volatility index. And so this will show slight spikes as traders hedge or reduce their exposure. So a market correction, I'm going to move me out of the way over here. A market correction, what defines a market correction? So we're going to see, we see that indexes are going to fall 10 to 19%. Indexes are going to be the S&P, the Russell, the NASDAQ, and the Dow Jones. It's going to last less than 6 months. That's the timing. And so there's concern, but there's not panic. And consumer sentiment is going to have increased uncertainty. There'll be short-term worry. And so for investor sentiment, there will be uncertainty. A bear market. So what's going to define a bear market? We move over here, we see the indexes fall 20%. Those are the indexes. This is going to happen over several months. And so there's fear, got a little graphic, got a little creative here. Consumer sentiment, reduced spending, media-driven pessimism, job security worries, and income instability. Investor sentiment, there'll be wealth and retirement concerns, and people will be looking at their 401ks or their investments falling 20%, which can have a drastic impact, especially for retirees at the time of retirement. So that can have a great impact. So you'll notice fear. So recession. Now this is going to be worse. What defines a recession? Recession goes into gross domestic product, which is GDP. And we're going to have 2 consecutive quarters of declining GDP. Unemployment will rise. So jobs will become more scarce and unemployment will rise. Layoffs will occur. There will be a slowdown in factory or industry or business. And so there'll be reduced spending and layoffs. And then there'll be stress and fear for the average investor or just individual, because as we were purchasing a lot of goods prior, those goods get smaller and smaller, right? We can't purchase as much as we could before. We might pick up gigs, second and third jobs. And what I mean by jobs is you might have garage sales. You might become a handyman to help out the neighbor to put some extra cash in your pocket. We might try to build up those savings more. And so we do cover savings, budget, paying down debt. We have lots of courses, we have lots of videos, we have blogs, ebooks. We have every tool that you need, because what we want to do here is equip you not only with the information, but with the tools so that you can not only survive, but that you can thrive, because that's what I am here to help you thrive. That's what I want you to do. A depression. So thinking about depression takes me back to 1929, the Great Depression, right? It's going to be greater than 10% fall in gross domestic product or GDP. And this is going to last for years. Unemployment is definitely going to be very high, and there will be bank collapses, corporate collapses. Businesses will begin to struggle. They're going to reduce spending. They're going to be laying off workers. They're going to tighten up. And we'll notice some of this tighten up happening right now. But this, we are not in the depression. There'll be terrible stress and fear. Same thing as the recessionary. People will be worried about their bills, and there'll be less money flowing around. It's one term we're hearing about in economic news, business news. If you read or if you watch the news, is stagflation. So stagflation is going to be stagnant growth and inflation. GDP, which is gross domestic product, will level off or become stagnant or grow at a very slow pace. There'll be very high unemployment. There'll be very high inflation. And of course, stress and fear for the average consumer, because, they'll be stressing over the bills. They're going to cut back on wants, and they'll only have needs. And it might be hard to meet some of those needs as well. So an example of stagflation in the 1970s, the US economy had oil shocks, and these oil shocks drove inflation. GDP stagnated, unemployment rose, central banks were stuck lowering rates, which fueled inflation, raising interest rates, which killed growth. And so when you have interest rates that rise, for example, if you're in, let's say, homeowners, first-time home buyers, they can afford less home because that interest rate pushes that mortgage amount up, that monthly mortgage amount. And so you'll have less home with a 6% rate as opposed to a 2% rate. Current homeowners, for example, will probably stay in their home and improve the household, because they wouldn't want to um, move into a higher interest rate. Now, there are ways that you can refinance and such. We won't get into that. I just want to provide you some basic information, some basic examples of what could happen. Businesses would, the same. They would cut back on their borrowing, because if I borrowed 100,000 at 2% because it's a great environment, I might can borrow another 100,000 and flip that for 7 or 8%. But when I'm start to borrow 100,000 at 7%, now if I flip that same 100 and I'm only getting 7% back, I can't continue to leverage these loans to grow my business. It doesn't make sense. And so I might have to start laying off workers. I might have to pull back on my ROI, or not ROI, but my investments, our research and development. I might have to pull back on hiring. I might have to have hiring freezes. I might have to have wage freezes, because we can't afford that increase. because we're not making enough money to afford that increase. So let's go to current day. How could 2025 lead to stagflation? Tariffs fuel inflation. So there's a new 10% to 145% tariff on imports, especially from China, which could increase the cost of goods. And we'll get into this a little bit. But businesses are going to pass these costs on to consumers, making inflation rise. And that means that the cost that you pay for an average good, which could be chips, eggs, for example, even though that has other impacts such as, the bird flu and some other things that have impacted that. But basically, you've seen the cost of your goods rise. And there's a way to measure this. If you've ever ordered products from your grocer or any retail chain, you can go back and fill that cart with the same amount of groceries, and they might have a historical figure. And then if you fill the same cart, you can compare those figures, and you'll see that it'll cost you more today for those same amount of goods, maybe 2 or 3 years ago. Tariffs also reduce trade flows, so there'll be supply chain bottlenecks, which increase price pressures. So if I'm a business owner and I'm ordering my goods, let's say I have shoes and clothes, a clothing store, I sell shoes and clothes, I order these things from China. The tariff, I have to pay a tariff as a U.S. business owner. And in order to make my profit, my cost of goods have increased with that tariff. And then if there's a supply chain bottleneck, now I'm not getting my goods in a timely fashion. So there's a holding cost. And so I have to now pass that holding cost and that tariff cost onto the consumer. So if I've been selling my shoes and shirts for $50 to $75, now I have to raise the price to $95 to $125 just to keep my business profitable and to keep food on the table for my family. There could be bond market volatility, which will limit growth. So treasury yields are spiking 4.6%, and this is making borrowing expensive. Higher rates is going to be tighter credit for businesses and consumers. And so we kind of explored that a little bit. Whereas if I'm a business owner and I have a higher rate on a loan, now I have to work harder to sell goods and to try to make that profit and pay that loan back on top of that high interest rate. So that means I'm going to borrow less, which is going to slow spending, which can equal sluggish gross domestic product growth. There could be political uncertainty, which will stall confidence. A change in administration or economic leadership could derail long-term industrial plans. Markets and companies may delay hiring or investment due to lack of clarity on fiscal policy, regulation, and global trade posture. AI and automation can create job displacement. So despite technological innovation, automation could eliminate jobs faster than the economy creates new ones. That's going to lead to rising unemployment, even while inflation persists, a key stagflation condition. And weak consumer sentiment. Now, we covered consumer sentiment. Households are already feeling pinched by inflation and higher interest rates. And if job losses rise or if spending contracts further, the gross domestic product could slow to a crawl even while prices remain high. What I want to cover is a timeline. I'm going to stop this presentation. Then we'll get into a little bit more about me. I wanted to bring you the facts, but I want you to know that the facts are coming from a credible source. But timeline, we're going to cover 1987, the public finance, 1987 crash called Black Monday. We're going to cover dot-com bubble, 2000 to 2002. We're going to cover 2007 to 2009, which was the global financial crisis. We'll get into 2020, which was the COVID-19 crash. And then we'll get into where we are today, which we're in a market correction. I'm going to end this presentation. I'm going to pull up this chart here. I'm going to scroll over. So this is a heat map, and this is going to cover, I'll explain this to you. Don't let it be too difficult. It's fairly easy. I know we might not like these Excel spreadsheets, but this really displays the information in a fantastic way. So we have the years up at the top with the crashes at the top. We have the market performance on the left side, along with the index's individual performance. We're going to get into the recovery period in months of how long it took to recover. We'll go into the reason for the breakdown. We'll have economic impacts, key drivers, and the classification. And so we see 1987 crash, Black Monday, 34% total market down. And so we see about 30% every index is down. The recovery period was 23 months. My computer's going to restart in 4 minutes. That's not good, but hopefully I can finish in 4 minutes. The reason for the breakdown is program trading, overvalued markets, a lack of circuit breakers, which triggered panic selling. The economic impacts were largest single day drop in the Dow history, which led to circuit breaker rules being placed and tighter regulation. The key drivers for this: automated trading, leveraged portfolio, insurance strategies, and investor panic. So this is classified as a crash and a correction. Well, it will be a bear market because it was down more than 20%. Dot-com bubble, negative 49%. So everything's cut in half. Everything that you saved for or that you're invested in, cut in half. You can see the index performance. NASDAQ is huge with a negative 78% and took 93 months to recover. It lasted 2 years. There was speculative tech stock bubble. It burst after overvaluation. So people were saying, "Oh my God, this is going to be the next this, that, the other." And when the companies came out with earnings, or when they noticed that these companies weren't going to be as profitable as prior companies that may have lasted through that bubble, investors pulled out. So economic impact, stock market lost 49%, long, slow recovery. Key drivers, overvalued IPOs and weak earnings, which led to investor panic. Bear market and a recession. Let's go to the global financial crisis, 2007 to 2009. Huge drop, over 50%. Indexes all over 50% drop. Took 49 months to recover, so not as long as the dot-com bubble. But there were housing market collapses due to subprime mortgage crisis. And so these subprime mortgages, people were getting approved that really couldn't afford it. And that once everything started to hit the fan, when businesses were reselling these mortgages to other companies, they had to write that whole mortgage portfolio off of their balance sheet. And that led to bank failures. Unemployment hit 10%. GDP fell sharply. There was a credit crunch and a housing price collapse. There was a bear market and a recession. So if we go to COVID-19, 34% lost, everything, all the indexes down over 30%. It took 6 months to recover. Now, this is different. This is a global pandemic, which led to shutdowns and demand shock. Rapid market drop, but fast recovery with stimulus. Now, this stimulus has led to inflation because you can't just get free money. And this was a health crisis. There were lockdowns. There was a global travel halt. Supply chains were backed up. And this was a crash or a recession. 6-month recovery, though. Look at where we are now. All green. This is purely a correction. There were tariffs bond market liquidity issues, and political uncertainty. Treasury yields are spiking, inflation fears, and global tensions. Import tariffs, lack of confidence in U.S. debt, and political instability. So this is a correction, and there is a risk of stagflation. So we haven't hit that yet, but there's a risk of stagflation. And so in here, hopefully my computer doesn't just restart on me, but key economic catalysts, we won't get into each one in detail, but things that could lead up to that stagflation are escalating trade wars, tit for tat wars. China has retaliated with tariffs of its own, and tit for tat escalations disrupt global trade, increases costs for businesses and consumers, and raises the risk of recession. That's the Wall Street Journal. Rising inflation and interest rates. Tariffs are contributing to higher inflation, with projections reaching 3.5% to 4% this year. The Fed maintains interest rates between 4.25 and 4.5, aiming to control inflation. However, elevated rates can dampen economic growth and increase unemployment. Bond market volatility. The bond market is experiencing significant turbulence, with the 10-year Treasury yield nearing 4.6%. Such volatility can undermine investor confidence and complicate financing for businesses and consumers. That's Wikipedia. Consumer confidence decline. Economic uncertainty and inflation are eroding consumer sentiment. A decrease in consumer spending can lead to reduced business revenue and potential layoffs, further slowing the economy. That's political. Corporate caution. Corporate caution. Major financial institutions, including JP Morgan and BlackRock, report strong earnings, but they express concerns over economic instability. They note increased loan loss provisions. That means that they're anticipating that their loan portfolio will have increased losses. And they're advising on maintaining robust capital reserves in anticipation of economic challenges. So if prices or inflation goes high, those capital reserves, which means I'm just conserving cash over here instead of putting into research and development, instead of hiring more workers, instead of adding more buildings or sites, instead of expansion, I'm just going to conserve my capital because we might have to meet a higher cost in the future. Political uncertainty due to administrative changes. So the current administration's aggressive policy shifts, including tariffs, regulatory changes, have introduced uncertainty into the market. Such abrupt changes can disrupt long-term economic strategies and investor confidence. If another administration is not on board with the same plan, all the current administration's work could be undone. So if future administrations don't agree with bringing the jobs back and what this current administration is doing, then that could disrupt future long-term plans. Now, I do want to dig into technological displacement. So automation, AI, and robotics is growing at a rapid pace, and so that could have job displacement risk. Rapid advancements in AI and robotics are increasing productivity, but they could also displace millions of middle and low skill jobs in manufacturing, customer service, logistics, and even some white collar roles like legal, accounting, coding. And so we see that very slowly happening with the cashiers. Where are the cashiers? You're doing it yourself. They've got the robots, the computers, and you're self-checking out, right? Even fast food places are now, for consistency within their food, they've got robots in the back that can prepare the food for you, push it out to you. And so this displaces workers. Wage pressure. As employers adopt automation to cut costs, wage growth could stagnate or decline, reducing consumer purchasing power and slowing demand-driven growth. So for example, if I'm an employer and I have an employee that's doing simple tasks, I may not need that due to automation. And so because I'm efficient, saw something happen, but because I'm working efficiently, I can now hire somebody at a lower cost to maybe aid the automation, for example. Uneven economic gain. Productivity and profit gains from AI often concentrate in large corporations and tech sectors, contributing to economic inequality, social unrest, and market imbalances. There could be investment shifts. Venture capital and corporate investment may flow away from labor-intensive industries, disrupting traditional sectors and increasing volatility in equity markets. While automation and AI, they do promise long-term efficiency and innovation, they may erode short-term job stability, wage growth, and consumer confidence, all critical pillars of a healthy market. If paired with the other risks like inflation or trade shocks, these forces could accelerate a downturn or even catalyze a modern form of stagflation. So I just want to let you know what it is. We aren't doing as bad as previous corrections or bear markets that we've been into. We're not doing that bad right now. But if these catalysts come into play, it could go worse. Now, if they don't, if everybody, if things work out accordingly, then this would just be a pure market correction, not too much to worry about. We are feeling it in the pockets though. I'm going to go ahead so I don't keep you, just to give you a little bit more about myself. I appreciate you for staying with me this long. I know it was a lot of education that we provided you, but we pride ourselves in research. My name is Brennan. I'm an investment insights consultant here at Biddles Group. I have an MBA in finance. I'm a treasurer of two nonprofits, a very much an advocate of financial education, and I'm a wealth strategy educator. I also am a transformation consultant and revenue cycle. And so I do want to explain that my content is just to educate, inform, and analyze. This content is for educational purposes only and does not constitute financial advice. Please consult a licensed advisor for personal investment decisions, and we do have network partners that are licensed that you can reach out to me and we'll connect you with one of our network partners that we've vetted and that we trust to do the right thing by you and your family. They're not going to get you into anything just because they get a commission off of it or anything like that. We don't believe in that here. And so we do offer investment strategy consultations. We have a weekly market strategy, stock and crypto review. We've got courses, ebooks covering debt, budget, saving, investing. We've got financial wellness workshops for corporations and nonprofits. And you can contact us. Our information is right here. And I do want to invite you to check out our Investor Edge dashboard. I was playing around with coding and AI. We've custom selected 877 stocks that may grow, but we have a custom stock selection momentum screening tool at biddlesgroup.com/investors edge. And we also have a weekly market strategy, stock and crypto review. You can get some of those on our website. You can get a summary of it. We have video summaries, or you can join that weekly review as we go through the stock market and we go through the indexes, the sectors. We select individual stocks. We give you good charting and education, and it's very valuable. So I do want to wish you happy trading. I do want to wish you financial wellness. I do thank you for staying with me for this time. I do thank my computer for not shutting off. And so we don't want you to only survive. Again, we want you to thrive. So continue to think big and dream big so that we can be on the beach right here like this together. All right. Signing off, I'm Brandon from Biddles Investment Group, and I want to thank you for your time.